PayPal, the company that convinced the world to stop reaching for its wallet and start clicking a button instead.
Founded in 1998 as Confinity by Peter Thiel and Max Levchin, PayPal was built on the idea that the internet needed its own native currency transfer system.
eBay acquired PayPal in 2002, embedding it as the default checkout method for millions of online auctions and giving the product unmatched distribution at a critical moment.
In 2015, PayPal spun off from eBay and became an independent public company, free to pursue partnerships with other e-commerce platforms and build its own merchant network.
Today, the platform processes over $1.5 trillion annually in total payment volume across more than 400 million active consumer and merchant accounts.
PayPal's revenue model is primarily transaction-based. It earns a take rate averaging around 2.2% on the value of payments it processes across its platforms.
The brand family includes Venmo for peer-to-peer transfers, Braintree for enterprise merchant processing, Xoom for international remittances, and Hyperwallet for marketplace payouts.
Venmo is particularly valuable as a consumer brand. It commands dominant awareness in U.S. mobile payments among consumers under 40, though fully converting that audience to revenue took years.
Braintree sits in the background, powering the checkout infrastructure for large internet companies. Those enterprise relationships represent high-volume, sticky revenue, even if the consumer brand is invisible.
The key competitive metric is transactions per account. PayPal tracks this closely because higher engagement means deeper reliance on the platform and better economics per user.
On the competitive landscape, PayPal faces Visa and MasterCard at the network layer, Block and Stripe at the merchant layer, and Apple Pay and Google Pay at the consumer layer.
That is a crowded field. PayPal's transformation strategy centers on fast-lane guest checkout, Venmo monetization, and disciplined cost structure across its core payments platform.
Fastlane is designed to make one-click guest checkout faster and more conversion-friendly for merchants, addressing a major friction point where shoppers abandon purchases at checkout.
The advertising initiative leverages PayPal's transactional data, billions of real purchase events, to build a closed-loop ad measurement platform similar to what Visa and MasterCard have been developing.
PayPal operates across more than 200 markets globally, making it one of the few fintech platforms with both developed and emerging market presence at meaningful scale.
Unlike Visa and MasterCard, PayPal does not pay a dividend. It returns capital through share buybacks, having reduced its share count significantly over recent years.
The strategic question for PayPal is whether its brand and network can hold the center of digital payments as specialized competitors attack it from multiple directions simultaneously.
The two-sided network of over 400 million accounts is still PayPal's deepest moat. Merchants keep the PayPal button because consumers expect it to be there at checkout.
The Fastlane conversion lift, the advertising revenue build, and the PPCP platform for merchants are the three transformation proof points investors will track most closely going forward.
PayPal pioneered internet payments and now must reinvent itself inside a market it helped create. The network advantage is real. The question is whether management can fully activate it.
PayPal beat both lines in Q1 2026, and the stock dropped 10%. Adjusted EPS came in at 134 versus consensus of 127, a 5.5% beat. Revenue of $8.35 billion topped estimates by 3.7%. The headline is the Q2 guide, which signaled the toughest year-over-year comp of the year. This is Charged Alpha. Let's break it down.
For context, PayPal carries a market cap of $42 billion and trades at just 9 times forward earnings. Q1 was new CEO Enrique Lorez's first earnings report after Alex Criss was fired in February. Lorez spent 37 years at Hewlett-Packard before being recruited to lead PayPal's transformation. The stock reaction tells you investors are not yet convinced.
The headline beat had two components. Non-GAAP EPS of 134 was up 1% year-over-year, beating consensus by 7 cents. GAAP EPS came in at 121, down 6% year-over-year, weighted by $10 million of one-time costs from the Criss exit. The non-GAAP number is the cleaner read on operations.
Revenue of $8.35 billion grew 7% year over year. The underlying engine, total payment volume, reached $463.96 billion, up 11% on a reported basis and 8% on a foreign exchange neutral basis. That is the broadest measure of activity flowing through PayPal's rails.
Branded checkout, the franchise problem that ended Chris's tenure, finally showed sequential improvement. Currency-neutral growth ticked up to plus 2% in Q1 from plus 1% in Q4. That is not a turnaround yet, but it is the first sequential acceleration in branded checkout in several quarters. Europe remains weak. The United Kingdom and Germany pressured the segment.
Venmo continued to be the bright spot. Total payment volume grew 14% on an FX-neutral basis, the sixth consecutive quarter of double-digit growth. Pay with Venmo TPV grew 34%. Venmo now represents 19% of total PayPal TPV, up from 18% in Q4. Monetization is finally catching up to engagement.
Braintree and the broader payment service provider business saw volume growth accelerate to plus 11%. Enterprise payments grew in the mid-teens. Buy Now Pay Later TPV grew 23% year over year, outpacing the broader BNPL market. The diversification away from pure branded checkout is working as a hedge.
On margins, the picture is mixed. Gross margin held near 45.6%. Non-GAAP operating margin compressed 229 basis points year over year to 18.4%. GAAP operating margin compressed 182 basis points. Take rate pressure from mix shift toward lower margin products is the structural drag management must address.
Free cash flow generation remains strong. Adjusted free cash flow grew 25% year over year to $1.72 billion. PayPal repurchased $1.5 billion of stock in the quarter, continuing the aggressive buyback that has reduced the float by approximately 15% over the last 3 years.
The balance sheet is solid. Cash on hand is just over $8 billion against $10 billion of debt. Net debt is just under $2 billion. Total assets of $80 billion include the customer transaction settlements, so the net financial position is much stronger than headline numbers suggest. The current ratio of 1.3 is healthy.
PayPal trades at 14.5 times trailing earnings and just 8.5 times forward 2026 estimates. Price to sales is 1.3. EV to EBITDA approximately 9. By any conventional measure, PayPal screens cheap. The valuation reflects the multi-quarter deceleration in branded checkout combined with active account growth flatlining at plus 1%.
Wall Street's positioning is decisively cautious. The consensus breakdown is 14 buy ratings, 24 holds, and 3 sells. The average price target is around $75, implying nearly 60% upside from current levels, which signals analysts believe in the long-term franchise, but not the near-term execution. Truist Securities maintains a sell.
The bull case rests on 3 pillars. First, the Loers transformation. The new CEO unveiled a 3-pillar reorganization in his first call: checkout solutions, consumer financial services, and Venmo and payment services. He committed to $1.5 billion of gross run rate cost savings via AI and reorganization to be reinvested in growth.
Second, the Venmo monetization runway. With Pay with Venmo TPV growing 34% and Venmo now 19% of total TPV, the higher-margin consumer financial services segment is finally scaling. If Loers can accelerate Venmo's transition into a transaction fee engine rather than just a peer-to-peer utility, the take rate compression story reverses.
Third, the valuation backstop. At 8.5 times forward earnings and a 5% cash flow yield to enterprise value, PayPal is priced for stagnation. Any traction on branded checkout, any cost savings outperformance, any Venmo monetization upside re-rates the multiple meaningfully from a depressed base.
The bear case starts with the Q2 guide. Management flagged approximately 3% transaction margin dollar decline and 9% non-GAAP EPS decline as the toughest comp of the year. That is a lot of damage from a single quarter. Investors price in execution risk on a guide that already assumes meaningful softness.
Second concern, active accounts only grew 1%. PayPal's user base has effectively flatlined for 2 years. That stagnation forces all growth onto take rate per user expansion. which is structurally hard when the mix is shifting toward lower-margin Braintree and PSP volume. Without account growth, the long-term revenue trajectory is constrained.
Third, the European softness. United Kingdom and Germany weakness in branded checkout is being driven by macro pressure and competition from local payment networks. Loraz's first call did not articulate a specific European playbook, which leaves a meaningful revenue drag without a clear catalyst.
PayPal's competitive set is wide. Visa and MasterCard are the network rails. Block, formerly Square, competes for merchant relationships. Stripe and Adyen compete on the enterprise PSP layer. Apple Pay and Google Pay compete at the consumer wallet layer. PayPal's defensive moat is the dual-sided network of consumers and merchants, but every layer is under pressure.
Versus Visa and MasterCard, PayPal trades at less than half the multiple, but those networks generate higher operating margins and benefit from card spend tailwinds without the platform execution risk PayPal carries. Versus Block, PayPal has greater scale but slower revenue growth. The choice between them is execution conviction versus value entry point.
Versus Adyen, PayPal is much larger but trades at a fraction of the growth multiple. Adyen captures premium pricing for clean enterprise payment processing. PayPal's branded checkout is a different business, closer to a consumer wallet than a pure-play PSP, but the comparison highlights why PayPal's multiple has compressed.
Options activity around the Q1 print was cautious. Put-call ratio above 1 reflects elevated put buying as investors hedge the Q2 guide softness. Implied volatility spiked post-print and remained elevated for at least a week. The options market is pricing meaningful uncertainty about whether the Loraz cost savings plan delivers without further revenue erosion.
On insider activity, the focus is the CEO transition itself. Chris's exit triggered $10 million in costs hitting GAAP results. Loraz received standard onboarding equity grants. There has been no notable open market buying or selling from board members in Q1, consistent with quarterly transition periods. Watch for insider buying signals in Q2 if Loraz's plan gains traction.
One important valuation note, PayPal does not pay a dividend and has no plans to start one. The capital return story is entirely the buyback. With $1.5 billion in repurchases per quarter at the current market cap, PayPal is retiring shares at roughly 14% of float annually if pace continues. That is the primary lever for per-share earnings growth.
Bottom line on PayPal, this is a turnaround story under new leadership, not a steady compounder. The Q1 beat is real but small. The stock reaction tells you investors want to see Loraz's cost savings plan execute over multiple quarters before re-rating the multiple. The valuation is genuinely cheap, but cheap can stay cheap for a long time without growth catalysts.
For value investors with a multi-quarter horizon, PayPal at 8.5 times forward earnings offers a credible entry point with a 15% annual buyback yield. For investors needing near-term momentum, the Q2 guide makes this a wait and see. Track branded checkout currency-neutral growth and the Loraz cost savings execution as the key catalysts going into the back half of 2026.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.